Suhana Khan, daughter of Shah Rukh Khan, was officially listed as the agriculturalist in documents related to purchase of farmland in Alibag because declaring one as agriculturalist or farmer can help in getting tax exemptions. The BCCI, despite making massive profits through the IPL, enjoys tax exemptions by claiming to be charitable and non-profit body which is promoting cricket. And then there is wedding loophole where newlyweds receive expensive gifts like property, jewelry, even stocks, all tax free if it comes from immediate family. These are not isolated incidents. They are clever exploitation of a system designed with enough flexibility for the rich to bend the rules and quietly walk away without paying their fair share in the tax pool by using the legal gray area. There is concerning trend in India. The wealthiest individuals report significantly lower incomes relative to their vast wealth, leading to minimal tax contributions. There is widespread tax avoidance among the ultra-rich, who constitute 0.1% individuals, and the income tax paid by them is as low as 0.7% of their total wealth. So richer a taxpayer, the smaller is the share of income tax paid relative to their wealth. Backing this pattern is a well-documented study by Professor Ram Singh, who is a member of RBI's Monetary Policy Committee and is also a director at the Delhi School of Economics. His research is based on the general election findings, Forbes list, and the income tax data from the Central Board of Direct Taxes. The research reveals that a significant portion of capital income earned by affluent groups never show up in income tax records. The study highlights that a widespread tax avoidance is a major reason why the ultra wealthy appear to have such low income to wealth ratios on paper. Simply put, the Indian tax system fails to be truly progressive when it comes to taxing wealth, letting those with the most contribute the least. To understand this better, we need to break down the difference between income and wealth. Income is the money you earn regularly, like salary, business profits, or rent. Wealth, on the other hand, is what you already own, like land, property, stocks, luxury cars, or gold. Now, a low income to wealth ratio means someone is extremely wealthy but reports very little income. For example, if a billionaire owns massive assets but shows barely any annual income on paper, they end up paying minimal taxes even though they live a life of luxury. This gap is often created by smart tax avoidance strategies, loopholes, and underreporting, which is why the richest appear poor when it comes to income tax, but in reality, their wealth keeps silently growing. According to Professor Ram Singh's research, this mismatch becomes even more striking when you compare income and wealth across different classes. The bottom 10% of households usually report incomes that are almost double their total wealth. This means that they are earning more than they own and likely spending most of it just to survive. In sharp contrast, the top 1% report incomes that are just 3 to 4% of their total wealth. That's the core of income wealth disparity. The poor have little to no wealth and must rely entirely on income which is fully taxed. The ultra rich, however, sit on massive pools of wealth that remain largely untaxed while reporting only a silver of it as income. The result? A system where the poorer you are, the more honestly and heavily you are taxed, and the richer you are, the invisible your real financial power becomes. And here it gets even more troubling. Despite having far less income and wealth, the bottom 50% of Indians contributed a staggering 64% of total GST collections in 2021 to 22. In contrast, the top 10%, the richest slice of the population, contributed just 3%. That means the financial burden of running the country is squarely falling on the shoulders of those who are already struggling. Since GST is an indirect tax applied equally whether you are rich or poor, it eats up a much larger chunk of a poor person's income than it does a wealthy person's income. This makes the tax system regressive. Instead of taxing more from those who can afford it, the structure takes more from those who can't give. In simple terms, the poorer you are in India, the more every rupee you spend is taxed. The richer you are, the easier it becomes to protect and grow your wealth, often without ever truly contributing your fair share. Now, the problem of tax evasion runs deeper than just ultra rich. The problem of tax evasion is also widespread among the middle and above average wealth groups. While these households often report relatively high incomes, it does not mean that they are declaring everything. In fact, the trend shows that as the person's ownership of agricultural land and commercial property increases, the portion of reported income actually declines. Across wealth brackets, many taxpayers underreport or misclassify their incomes, especially by exploiting the tax-free status of agricultural income and by hiding parts of their rental earnings. For those in the middle and upper middle classes, farmland and property form a larger chunk of their assets, and that's why a significant amount of tax leakage happens. So while the poorest are overtaxed through consumption and the richest escape through wealth shielding, a sizable chunk of the middle class is quietly bending the rules, making tax evasion structural issue across the spectrum, not just the top tier problem. The gap between the rich and the poor isn't just a matter of taxation. It's fueling a much deeper inequality crisis in India. Between 2012 and 2021, the top 1% of India's wealthy captured 40% of all wealth created in the country, while the bottom 50% received just 3%. India is already grappling with dangerously high levels of income and wealth inequality. And when you add tax exemptions for the rich on one side and the GST burden of GST on the other, it becomes clear that the system is not just imbalanced, it is actively widening the divide between the rich and the poor. Now, just to put these inequality numbers into perspective so that you can really grasp the scale of the gap, even the politicians in India sit far above the average citizens when it comes to wealth. In 2019, the average family wealth of a Lok Sabha MP was around $938,311, while the average Indian household owned just $26,857. That's not a small difference, it's a wealth gap of nearly 34 times. For context, in the United States, this gap between politicians and the general public is about 1:4. In India, it is around 1:37. This staggering disparity raises a critical question. When the people making the rules are that much wealthier than the people living by them, whose interests are laws really serving? In 2019, the central government made a big move. It slashed the corporate tax rates from 30% to 22%, and for newly incorporated companies, the rate dropped even further to just 15%. This might sound like a business-friendly reform, but it came at a massive cost, which is the revenue loss of around 1.45 lakh crore rupees. That rupees 1.45 lakh crore, the government chose to forego the money that could have been invested in healthcare, education and infrastructure. While ordinary citizens continue to shoulder the weight of indirect taxes, big corporations walked away with one of the steepest tax cuts in decades. The growing inequality has deep economic, social, and political side effects. When the tax system allows such a wide gap between what the rich and the poor contribute, it doesn't really reflect inequality, it reinforces it. As the rich accumulate more and the poor struggle with stagnant incomes and high taxes, the economy suffers from insufficient purchasing power among the masses, slowing down the growth and job creation. India desperately needs inclusive growth to generate employment, but rising inequality is pulling us in the opposite direction. Every society has its own tolerance for inequality. Extreme wealth concentration distorts the democratic process. The super rich can influence elections, policies, and governance through campaign donations and lobbying, tilting the power further away from the ordinary citizens. This isn't just about fairness, it's about survival. If left unchecked, this broken system will choke our economy and corrode our democracy. This needs urgent correction for India to grow sustainably and equitably. To address this growing crisis, there have been increasing calls for creating a level playing field for all sections of society. The opposition, particularly the Congress Party, has emphasized the need to allocate more resources to historically marginalized economic and caste-based communities, arguing that corrective policy changes are essential to reverse the rising trends of wealth and income inequality. At the same time, there is growing debate around the redistribution of wealth. Finance Minister Nirmala Sitharaman recently opposed the idea of an inheritance tax, stating it could nullify India's decades of progress. On the other hand, some economists argue that taxing inherited wealth is not only fair but necessary. They believe that such a taxation could fund universal public education, affordable healthcare, low-cost housing, and even help tackle climate crisis, which disproportionately affects the poor. The message is clear. Taxing the rich may not be the only solution, but without inclusive growth and equitable distribution, the economy itself cannot expand in a healthy and sustainable way. Progressive taxation and greater social spending is essential not just to reduce inequality but to create real opportunities for those at the bottom of the economic pyramid. But taxation alone isn't enough. What's equally important is governance reforms. Tackling corruption, increasing transparency, and ensuring that every rupee collected in taxes is put to good use, and it is critical for the long-term progress. People must feel that their contributions are returning to them in the form of better public services, stronger social security, better sanitation, improved healthcare, and more accountable local governance. In the long run, trust in the system can only be built through good governance. When citizens see visible improvement in their daily lives, they begin to believe in the system again. That's how we move towards not just economic growth but inclusive, equitable, and sustainable development. That's it in this video. If you like the video, please press the like button and subscribe to the channel. Stay tuned for content like this. Thank you so much for watching the video.